Income Tax Law and Practice 01. Syllabus. Module Number 1. Basic Concepts of Income Tax. Introduction. Meaning of tax, types of taxes and canons of taxation, important definitions, assessment year, previous year including exceptions, assesses, person, income, casual income, gross total income, agricultural income, tax rates, old and new regimes. Exempted incomes of individuals under Section 10. Introduction to income tax. Income tax is a financial levy imposed by governments on individuals and businesses, typically based on their income or profits. It serves as a major source of revenue for governments to fund public services and infrastructure. Income tax can be progressive, meaning the tax rate increases as income rises, or flat, where the same rate applies to all income levels. Individuals report their income, deductions, and credits on tax returns, and the amount owed or refunded is determined based on the applicable tax laws and regulations. Different countries have varying tax codes and systems, making it an essential aspect of personal and corporate finance to understand and comply with income tax requirements. Meaning of tax. Tax is money that individuals and businesses are required to pay to the government. This money is used to fund public services like schools, hospitals, roads, and more. It's usually a percentage of a person's income or the cost of goods and services. Types of taxes. The two main types of taxes are direct taxes. These are taxes that are directly levied on individuals or entities and cannot be passed on to someone else. Examples include income tax, property tax, and wealth tax. The burden of direct taxes falls on the person or entity responsible for paying the tax. Indirect taxes. These taxes are imposed on the purchase of goods and services and can be passed on to the end consumer. Examples include sales tax, value-added tax, VAT, and excise tax. Indirect taxes are typically collected by businesses and then remitted to the government, and the cost is often included in the price of the product or service. In detail, types of tax. Income tax. This is a tax on the money you earn from your job, investments, or other sources of income. Sales tax. It's a tax added to the price of goods and services when you make a purchase. Property tax. This tax is based on the value of your property, typically your home or land. Corporate tax. Businesses pay this tax on their profits. Higher profits. Excise tax. It's a tax on specific goods like alcohol, tobacco, and gasoline. Capital gains tax. This tax applies to the profit made from selling investments or assets like stocks or real estate. Estate tax. It's a tax on the property and assets you leave behind when you pass away. Payroll tax. This tax is taken directly from an employee's paycheck to fund programs like Social Security and Medicare. Value-added tax, VAT. Common in many countries, it's a tax added at each stage of production and distribution of goods and services. Property transfer tax. Applied when property ownership changes, often during real estate transactions. Canons of taxation. Meaning of canons of taxation. The canons of taxation refer to a set of fundamental principles or guidelines for designing an effective and fair tax system. These canons were first formulated by the economist Adam Smith in his book, The Wealth of Nations, in 1776. The canons of taxation are as follows. 1. Canon of equality. This principle suggests that taxes should be imposed in a way that is fair and equitable. It means that individuals or entities with higher incomes or greater ability to pay should contribute a larger share of their income in taxes. This helps distribute the tax burden more fairly across society. 2. Canon of certainty. Taxpayers should have a clear understanding of when, where, and how they are expected to pay their taxes. The tax system should be predictable and transparent, providing certainty to taxpayers about their obligations, which encourages compliance. 3. Canon of economy. This canon emphasizes the importance of minimizing the cost of collecting taxes. The cost of tax collection should not be overly burdensome, as this would reduce the net revenue collected. An efficient tax collection process is essential to maximize the funds available for public use. 4. Canon of convenience. A tax system should be designed to make it convenient for taxpayers to fulfill their obligations. The process of paying taxes should be straightforward and user-friendly, which can enhance compliance and reduce administrative difficulties. 5. Canon of productivity. This is not one of the original canons but is sometimes considered in tax theory. It suggests that a tax system should be productive in raising revenue to fund government operations and public services effectively. It should generate sufficient funds to cover the government's expenses. 6. Canon of plasticity. Also not among the original canons, plasticity relates to the ability of the tax system to adapt to changing economic and social conditions. A flexible tax system can be adjusted when necessary to accommodate evolving circumstances. 7. Canon of simplicity. A tax system should be simple and easy to understand. Complexity can lead to confusion, errors, and higher administrative costs. A straightforward system benefits both taxpayers and tax authorities. 8. Canon of diversity. Diversity suggests that a tax system should include various types of taxes, e.g., income tax, sales tax, property tax, to distribute the tax burden across different sources. This reduces reliance on a single tax type and can make the system more robust. 9. Canon of fiscal adequacy. The tax system should be capable of generating sufficient revenue to cover the government's expenses, ensuring that it is fiscally adequate to fund public services, infrastructure, and other obligations. www. 10. Canon of flexibility. Flexibility in the tax system allows it to adapt to changing economic, social, and political conditions. A flexible system can respond to emerging needs and challenges over time. Important definitions. Th. Read. Definition of assessment year. Section 2(9) of Income Tax Act, as per Section 2(9) of the Income Tax Act, 1961. Assessment year may be defined as a year in which the income tax of the previous year is to be assessed. It is a period of 12 months, starting from April 1st of every year and ending on March 31st of the next year. Definition of previous year. Section 3 of Income Tax Act, as per Section 3 of the Income Tax Act, 1961. The term previous year means that the financial year immediately preceding the assessment year. Under income tax, the returns are filed by assessors after end of the year. Period during which earnings are made in that period is called as previous year, financial year. Definition of assessee. Section 2(7) of Income Tax Act, as per Section 2(7) of the Income Tax Act, 1961. The term assessee means a person who is responsible for payment of any tax or any other sum of money under this act, and includes an individual and Hindu undivided family, HUF, company, firm, association of person, AOP, body of individual, BOI, local authority and artificial juridical. Definition of person. Section 231 of Income Tax Act, as per Section 231 of the Income Tax AC, 1961. Person includes an individual and Hindu undivided family, HUF, company, firm, association of person, AOP, body of individual, BOI, local authority and artificial juridical persons. Read. Definition of income. Section 224 of Income Tax Act, as per Section 224 of the Income Tax AC, 1961. Income includes * profits and gains, * dividend, NNAT, * voluntary contributions received by a trust, Buttons Re, * the valve of a perquisite of profit in lieu of salary, * any special allowance or benefit other than perquisites included under 4. * any allowance granted to the assessee either to meet his personal expenses at the place where the duties of his office. * the value of any benefit or perquisite obtained from a company. Definition of casual income. Section 115BB of Income Tax Act, as per Section 115BB of the Income Tax ACT, 1961. Casual income means income in the nature of winning from lotteries, crossword puzzles, races including horse races, card games and other games of any sort, gambling, betting, etc. Such winnings are chargeable to tax at a flat rate of 30% under Section 115BB. Definition of gross total income. KV gross total income means aggregate amount of taxable income computed under 5 heads of income, i.e. salaries, house property, business and profession, capital gains and other sources. In other words, gross total income means income computed in accordance with the provisions of the Act before making any deduction under Sections 80C to 80U. Definition of total income. Total income is your gross income from all sources less certain deductions such as expenses, allowances, reliefs, etc. Salary XX, house property XX, business, profession XX, CG XX, XX, gross total income XXX, deductions 80C to 80UXX, total income XXX. Definition of agricultural income. Section 10(1) of Income Tax Act, as per Section 10(1) of the Income Tax Act, 1961. A. Any rent or revenue derived from land which is situated in India and is used for agricultural purposes. B. Any income derived from such land by agriculture operations including processing of agricultural produce so as to render it fit for the market or sale of such produce. C. Any income derived from saplings or seedlings grown in a nursery shall be deemed to be agricultural income. Exempted incomes of individuals under Section 10. 1. Agricultural income. Section 10(1). 2. Share of income from partnership firm. Section 10(2)(a). 3. Share of HUF income. Section 10(2). 4. Scholarships. Section 10(16). 5. Income as dividend. Section 10(34) and 35. 6. Allowance of MP/MLA Section 10(1)(7). 7. Capital gain on compulsory acquisition of urban agricultural land Section 10(37).